Hello, welcome back to Chapter 2 in Intermediate Accounting. This is the second video, and it's going to be a short one where we just refresh on T accounts. So if you recall from financial accounting, T accounts are only used for instructional purposes and for analyzing. So in the real world, in accounting, accountants are taking scratch paper and they are jotting down different T accounts to help them understand the process of what has happened throughout several transactions. So they are very useful. They're also useful for instructional purposes because this way I can show you what the actual debit and credit side look like and how that affects the accounting equation. So you may find these to be really helpful, and make sure that if these are things that you do find helpful, that you take the time to have that scratch paper there as you complete your homework, because I think T accounts can be super beneficial. So we know that at the top of the T account, and you see why it's called a T account, it looks just like a T, you are going to put the account name. So it could be cash, accounts receivable, inventory, accounts payable, common stock, whatever the account name is. And then we know that the left-hand side is the debit side. And I'm going to talk about how that relates to the accounting equation in just a minute. But the left-hand side is the debit side, whereas the right-hand side is the credit side. So we're always going to see that in every T account. Left side is debit, right side is credit. So you really could think of it along with the accounting equation, and how that is the left side, which is the assets, have a normal debit balance. Whereas the right-hand side of the accounting equation, the liabilities plus equity, they're on the right-hand side, they have a normal credit balance. So what that means is anytime we want to show assets increasing, since it has a normal debit balance, we would debit assets. So I'm going to show you that here, assets. And also expenses, losses, and dividends. We increase those with a debit because their normal balance is a debit. Whereas if we're going to decrease any of those, we would credit them. So assets, we increase with a debit, we decrease with a credit. And expenses, they are going to fall under equity ultimately, and we're going to see that in just a minute. They fall under equity because they go up under retained earnings, right? That profit that's reinvested. But since expenses decrease equity, which has a normal credit balance, expenses are debited. So if that's not making sense or not ringing a bell from when you went through financial accounting, don't worry. We're going to see it again in just a minute, but we're going to see it written out in a different way. But let me just remind you that expenses are always debited unless there's an error or you're doing the closing entries, which we'll cover later in this chapter. But expenses are always debited. And then we have losses. Those would also be debited always. And then dividends as well. And then we have the things that fall on the right-hand side of the equation, which again are liabilities. And then anything that falls under that equity section that increases it, we have paid-in capital, like common stock. Then we have revenue and gains. So all of those have a normal credit balance, which means you increase those with a credit and you decrease those with a debit. So let's look at it written out. This is going to be the last slide for this video. It's just going to be short and sweet because I know this is a lot to remember sometimes. So we have the assets equal liabilities plus equity. We have assets have a normal debit balance, so they increase with a debit, decrease with a credit. Liabilities are going to have a normal credit balance, and so does equity. Therefore, we increase them with a credit because that's their normal balance, and decrease those with a debit. Under equity, we're going to see paid-in capital, which we typically call common stock, and retained earnings. Both of those have the potential of increasing equity. So since they would increase equity, we would increase those with a credit, and we would decrease them with a debit. Now, within retained earnings, this is typically what is the trickiest part of the accounting equation, but super important for you to understand when it comes to the foundation of accounting is that retained earnings is that profit reinvested. It falls under equity, so it has a normal credit balance. So revenues and gains are going to increase your retained earnings. They're going to increase the profit that's reinvested. So those would also have a normal credit balance. But expenses, losses, and dividends decrease our equity. They decrease that profit we get to reinvest. If we had to pay a bunch of employees this year to work for us, that's going to be a lot of expenses that decrease equity. So if we're decreasing equity, we would debit. And so we debit expenses, losses, and dividends because dividends, yeah, we've got profit, but then we share it with our shareholders. I understand this part can be really tricky. And one big thing is that since cash is an asset and we know that assets are debited to increase them, a lot of times people associate debits with a good thing and credits with a bad thing. But that is not the case. We have to get that out of our heads that debits are a good thing and credits are a bad thing, because revenue, when we earn revenue, we credit revenue. Revenue is always credited unless we're trying to get rid of the balance so there's an error. But any normal entry with revenue is a credit. So credit's not a bad thing. That's what we are in business for, is to make revenue. So crediting is not a bad thing, but it just depends on which account it is. So make sure you have this part down, the inner workings of the accounting equation, before you move on, because this is really important, and it's super important to understand which accounts we debit and which ones we credit.